So China's flash manufacturing PMI has ballooned the line of 50, while equity markets are on fire. What does this dichotomy set up as an investment climate? Let's talk more with Richard Jerram of the Bank of Singapore.
I think there are concerns about global growth generally, but I think the market's really interested in what are the policymakers doing about those concerns. And of course, in the past 6 months, we've seen Japan pumping liquidity into the markets. You've seen the European Central Bank now since the beginning of this year also trying to stimulate, and I think the expectation is that in China as well, they're going to be trying to smooth the slowdown in the economy. And it seems that markets are much more focused on this liquidity impulse than they are on the actual growth numbers themselves.
Yeah, but the real challenge is China was sort of the shelter following the global financial crisis for many investors. And this time, China is slowing too. So what happens if the global bond markets start to unwind? That's the big risk, right?
Yeah, I think there are concerns that there's been such a chase for yield across the world that bond prices have really risen to very high levels, yields are very low. And at the same time, the slowdown in China and also the drop in oil prices is causing some stress in bond markets. Of course, we've seen a big Chinese property company defaulting on its debts recently as well. So I think the concern is that there's a lot of liquidity, there's a lot of money in these markets. And if you do have policy surprises, or if you do have maybe some economic stress that comes from the slowdown in China, perhaps feeding into commodity prices, then there are some vulnerabilities in the system.
Despite this default that we have in China's real estate sector, somehow you don't get the sort of jitters you normally get, you sense from the equity markets.
Well, some things tell you that people are too relaxed. So certainly if you look at the multiples that equities are trading on, basically no market is cheap at the moment. But on the other hand, if you look at how much cash people still have really remarkably high cash levels in their portfolios, which doesn't really make sense if you're saying that people are, very aggressive and very naive. I think it's one of these almost most unloved bull markets that we've seen, because prices have gone up, but there's really been not a huge amount of participation by many people.
The fact that huge global investment houses are starting to stress test their bond portfolios, does that signal that alarm bells could be ringing imminently?
Well, I think people realize two things. I think the first thing is that American interest rates are going up this year. The Fed is going to tighten policy. And when that happens, that's going to put some stress on bond markets because yields are so low at this point. I think the second thing is that, slightly more complicated, but regulation has reduced the amount of bonds that investment banks hold in their inventory.
Right.
And as a result, there's not very much liquidity. So when people want to buy or sell a lot of bonds, prices can move a long way.
When U.S. rates normalize, do you think that could really be the scenario that we could be looking at down the road?
Well, this is something the Federal Reserve has done a lot of work on. They've been trying to figure out, can we smoothly raise interest rates without causing too much stress in financial markets? Obviously, they've been doing a lot of work in this. I think the truth is it's a complex adaptive system. Nobody really knows until you try. And so simply delaying doesn't really solve the problem. In the end, they're going to have to start to raise interest rates because the US labor markets are looking really very tight now. They've got some inflation risk coming through, and so really the only way to find out whether portfolios are resilient enough is to raise interest rates and see what happens. And I think we're fairly close to that point now. Which
is why some people are wondering whether alternative investments are the place to be. And in fact, that's what we tweeted last week, asking whether alternative investment can offer better returns than capital markets. Here are some interesting reactions that we caught online. Lewis Cohen says greater risk means potentially greater reward and vice versa, a personal risk tolerance issue. And Bob Seawright says data to this point is clear, no. So going back to this topic of whether alternative investments can offer better returns in capital markets, what do you think?
Well, I think it's reasonable to have a proportion of your financial assets in alternative investments. I mean, to many people that means things like private equity or hedge funds as much as it means wine or watches, if you like. Because you've got to remember, these are generally very illiquid assets, so you don't want to have a large part of your portfolio in them. And there's not a lot of transparency on pricing either. And of course, for many people, income is important. But if you own a crate of wine, you don't get any income from that. And so you've got to be a little bit cautious about how aggressively you do chase these type of investments.